While on the subject of mistakes I've made and the desire for remonstration to learn from them, we need to talk about some trust issues. Sometimes I'm way too tough on management, and sometimes I give them too many free passes. Right now, I want to highlight a situation where I made the latter mistake, leaving too much in a great CEO's ability to turn around a genuinely broken company. Sometimes a company's in such bad shape that there's almost no coming back from it, even if they bring in a tremendously talented management team. Maybe a brilliant CEO can ultimately turn things around, but turning an awful business around is a process that can take years and years. It's not something you want to bet on right out of the gate. Yet that's exactly what I did with Foot Locker not long after they brought in Mary Dillon as CEO in late 2022. Dillon is a retail legend. She's the one who transformed Ultra Beauty into a nationwide cosmetic powerhouse. She took over in 2013. By the time she retired in 2021, the stock could give you a magnificent 245% return. In short, she is a legend. So when Foot Locker hired her as a CEO in 2022, I figured she'd be able to breathe new life into the struggling mall-based footwear chain. We brought her on the show in March of 2023, and while she stressed that the turn would take a long time, I thought she told a really compelling story. Heck, she even did a lot of insider buying, putting some money where her mouth is. She had a plan to close down the worst stores, and I was confident she could work her Ulta magic at Foot Locker. Although, again, I knew we'd have to be patient, and that's why we went as far as buying this one for the Charitable Trust in small position. But we bought it. In retrospect, that was a colossal error, a disastrous mix of ignorance and arrogance on my part. I knew turning around Foot Locker would be a Herculean task. I had so much confidence in Dillon's leadership that I figured everything would be fine no matter how hard the story got. While I put a lot of emphasis on the need for great management and how terrific CEOs can accomplish incredible things here, some things are impossible for even the best executives in the world. There are real-world constraints on what they can accomplish, so the great man or woman theory of investing only gets you so far. And look, it's not Mary Dillon's fault that I got this one wrong. She didn't mislead us. And when we bought the stock, she hadn't even been there long enough to accomplish a real comeback. Buying Foot Locker for the Charitable Trust was my screw-up. And while I'd love to pass the blame around to my colleagues or the people who run Foot Locker, the buck stops here. I said turning around Foot Locker would be a Herculean task, but even Hercules never needed to turn around a flailing, mall-based retailer, not his skill set. No matter how great the CEO, they can't fight the laws of nature, and that includes the merciless laws of the retail industry. Fast forward to late August of 2023, Foot Locker stock had already been obliterated when it reported an ugly quarter in May, falling from 41 to 30 in a single session. But the August quarter made that look like child's play. Cut myself a little slack. I told members of the investing club that it would be a horrible quarter ahead of time. However, that turned out to be a severe understatement. I had absolutely no idea how bad this thing could get. My first loss would have been my best loss. See, that August, Foot Locker reported one of the worst quarters I've ever seen. Not only did their sales sink 10% year over year, coming in weaker than expected, but their earnings plummeted 96% from the previous year. And that was actually an inline number because the analysts understood Foot Locker's business was awful. The thing that really hurt is that management also announced a pause in its dividend payments. Just a horrifying sign that the company didn't see anything getting better anytime soon. A lot of people were in this one for the payout. Foot Locker yielded more than 6% going into the quarter, and they immediately lost the best reason to stick with the stock. A dividend boost is generally a sign of confidence. A dividend cut suggests lack of confidence, but a wholesale pause in the dividend, that suggests a different kind of confidence. Confidence that business will be awful for the foreseeable future. Management blamed the weak consumer, changing vendor mix as they tried to diversify away from Nike, and a tough macroeconomic environment, one that was hurting their core lower-income customers particularly hard. Early in the year, Mary Dillon had outlined her turnaround plan coming off of a pretty strong holiday season. But by the summer of 2023, the company had seen a weak start to after-school season and a much more cautious consumer. As a result, Foot Locker had aggressively discounted its merchandise to unload excess inventory, you know how bad that is, and simply compete for market share. It got to the point where Foot Locker was burning through cash so rapidly, it looked like they might even have to tap the credit line just to stay in business. In response, the stock justifiably lost nearly 30% of its value in a single day, and for good reason. It was much worse than we had assumed, and any potential turnaround would take a lot longer than we were prepared to wait if it could ever happen. Of course, by the time we figured that out, the stock had come down so low that it didn't seem to be worth selling at all. But the worst part of this Foot Locker saga is that I really should have seen it coming. I was blinded by Mary Dillon's spectacular track record. And again, it's not her fault that the stock got killed in the year after she took over. This was a very troubled company, and it took some time just to assess the full extent of the problem. I still believe she's a great CEO. However, I always tell you that you never want to own the best house in a bad neighborhood. One of our guiding rules for the CNBC Investing Club. And Foot Locker wasn't even the best house in a bad neighborhood. It was a bad house in a horrible neighborhood that is mall-based shopping. It just happened to bring in a good contractor to fix things up. But there's only so much a contractor can do. When you're running a mall-based store based with, with lots of excess inventory, it's insanely hard to orchestrate a comeback. This is a lesson I should have learned back when I recommended American Eagle Outfitters, another disaster of a stock that obliterated the Travel Trust after it peaked in the summer of 2021. Boy, did I get that one wrong. Shame on me that I thought a mall-based stock like Foot Locker could be anything more than a product of its environment. I simply never should have stuck my neck out on this one, no matter how much I believed in Mary Dillon's leadership, because sometimes leadership is not enough. I had too much faith in a person and was too blind to what was happening to the very good management team in American Eagle, one of my worst picks since I started this open-handed stock picking experiment 20 years ago. The bottom line, management matters, sure, but when you bring in a new pilot on a crashing airplane, they can't defy gravity. Foot Locker was a disaster waiting to happen. That kind of comeback can take an extremely long time. We never should have bought this one so early. Pure hubris on my part. Hubris is an awful trait when it comes to investing, and I allowed it to cloud my judgment like a rookie would. Shame on me. Let's go to Mike in Illinois. Mike.
Hi, Jim. Thanks for taking my call.
No, I'm glad you called, Mike. What's up?
I'm looking to open a 529 plan for my 2-year-old granddaughter.
Excellent.
And I wonder what your opinion is, where I should invest it, where for the appreciation for the next 15, 20 years.
Okay, so let's just start by building up a nice position in index fund. You know what? I think what you probably want to do, I might even put maybe 35% in index fund before you even start thinking of some individual stocks. I just think it's a very, very conservative time, and that's what you want to do. Index funds are the way to go for 529 plans. Vinny in Connecticut. Vinny.
Thank you, Mr. Cramer, for taking my phone call, and I am a club member. I would like to know, if I buy an individual stock and it goes down, what percentage do I think about selling it?
Okay, well, look, I mean, if we change our thesis about it, then you should sell it. Or if I say, look, I don't like this one, I'm trying to hold it for the long term, but it's really rough, I don't think you should be in it, then I think you should sell it. Those are the guidelines, and, there's been a couple stocks I've said that for, and that's what I stand by. Irwin in New York. Irwin.
Hey, Jim, how are you?
I'm okay.
In Brooklyn.
Not bad.
I got a question for you. I know you have a wide range of listeners and watchers, and all different degrees of investment. Some are small investors, some are medium investors. I know you hate to have people having more than 5 or 6 stocks in their portfolio.
No, that's fine. That's fine. As long as you're excited about it. You want to do the homework.
I have 10 stocks at various prices. I don't know how to balance the portfolio.
Okay.
Let's say, for instance, I have 10 stocks and I have $10,000. Now, it's very easy to put $1,000 into each of these 10 stocks, but that doesn't seem like it's an equitable way to balance the portfolio.
Well,
what is the proper way?
Okay, well, I like to rank my stocks. Not all stocks can be ones. I have to put 1s, 2s, 3s. 3s, if they go up, you'll sell. 1s, you got to keep. 2s are in flux. And then I also would think, you know what? Let's pit the stocks against each other. Maybe just pick the best 5. I think that wouldn't be a bad idea. Thank you for the call and for your confidence. Hubris is an awful trait when it comes to investing, as I've learned from experience. You should never allow it to cloud your judgment, as I did mine. It's a rookie mistake that even seasoned professionals like me often make. Much more mad in the head. I'm revisiting a couple more bad calls I made for the Travel Trust, including some stocks in terrific companies like Disney and Boeing. I learned from my mistakes. Plus, my colleague Jeff Marks and I are about to take your questions about investing, retirement, and more. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.